Welcome everyone to this month, or this, I guess we don't do this every month, that's the wrong way to put it.
It's a third, right? Not a quarter. Yeah, we do 3 times a year.
Anyway, welcome to this on local government. We're going to take a look at state and local taxes in Indiana, and Larry will lead us through that, but I do want to go over just a few tech issues. So my name is Tamara. I'm a Purdue Extension Community Development Regional Educator, and I want to welcome you and also explain a little bit about WebEx. So you have, or you should see our screen, our PowerPoint on your screen. There should also be a box at the top that says we're sharing our screen with you. And if you mouse over that box, you'll see a chat icon. You're welcome to click on that. If you have any questions during the during the program, we will be answering all questions at the end. Feel free to type those into the chat box. As far as other things go on that screen, you are muted right now. We ask that you stay muted. And if you want to unmute when we get to the question and answer portion, that would be fine. But just to help with feedback, we'd like everybody to stay muted during the presentation. Finally, there is a participants box. You can click on that and see everybody that's with us today. There's a few buttons at the bottom of that. Sometimes we use these when we ask yes or no questions. There's a check mark or an X you're welcome to click on. But also if you're having any issues, feel free to use those as well. I see that some of you have had issues with audio, especially if you're connecting via iPad. I have never connected to WebEx via iPad, so I'm not sure it can be a lot of help, but I will try. And I'm going to type my cell phone into the chat box. That's the easiest way if you're having tech issues, to just go ahead and text me, and or email me, and I will be checking that and trying to help you with any tech issues that you have.
Don't call, however.
Don't call, please. So with that said, I'm going to hand things over to Larry, and welcome to this on local government.
All right. Well, thank you, Tamara, and we're pleased to be with you here again for On Local Government. I'm Larry DeBoer. I'm a professor in the Agricultural Economics Department here at Purdue and an extension specialist on state and local government. And today we're going to talk about a look at state and local taxes in Indiana, but specifically, how do taxes in Indiana compare to the rest of the country? And this is a question that I get asked not all the time, but every once in a while someone says, well, how do we compare? Are our taxes high? Are they low? How do they do it in other states? And sometimes I get asked, who does it well? Right? Are there other states that do that have tax systems that are really good, and other states maybe that are not very good, and where does Indiana rank among all these different taxes? And if you talk like that, you're thinking about what criteria might we use to evaluate taxes. So that's what we're going to do today. We're going to look at how high, how low Indiana taxes might be, and we'll look at in total. We'll look at state and local, and we'll look at the specific taxes, the major taxes, and then take a look at some criteria about how we might evaluate taxes, and then take a look at a couple of organizations, the Tax Foundation and a group called ITEP, that have analyzed taxes from a particular point of view, from a particular set of values, you might say, and see how we rate and how other states rate with these two groups. So with that, let's start out with how high or low are Indiana's taxes. And the question is, how are we going to measure that? So there's a number of choices. We could look at tax rates. If we wanted to look at tax rates, we could go to the website of the Federation of Tax Administrators, and there are several websites that will give you lists of tax rates, but the Tax Administrators Federation there is particularly good. So if you go to their website, and you can find charts, lists, tables of state by state, what are the tax rates. And so what we could do, say, is look at the sales tax. And if we did, we would see that Indiana's 7% state sales tax rate is tied for second highest in the United States. Now, California has just recently increased theirs to 7.25%, but we're up there, tied for second highest. So we're high on the sales tax according to the rates. Trouble with using rates for the sales tax is the tax base matters too. You know, Indiana taxes goods except groceries, and rentals and utilities, but not services. There are other states, South Dakota, Iowa, to name a couple, that tax a lot of services. There are some states that tax groceries. And so the composition of the tax base matters just as much as the tax rate for how much sales tax you pay. And the tax rate doesn't get at that tax base question. And then what about income tax rates? You know, most states don't have a flat rate income tax like Indiana does with 3.23%. Most states have graduated rates that are lower for lower income folks and higher for upper income folks. And what do you do about that? And one might also point out that there are local income taxes, 92 different local income tax rates in Indiana. How are we going to tabulate that sort of thing? And then, oh my gosh, what about property tax rates? There's more than 2,000 property tax rates in Indiana. And if you multiply that, if that's typical among the states, that would make 100,000 property tax rates across the country. How are we going to compare those? And then what about assessment practice? Right? Assessment practice differs pretty radically around the country. And so comparing tax rates, moral of the story, comparing tax rates, probably not the way to go when we look at taxes and whether taxes are high or low. There is one thing that we can do with property taxes, though, and that, oops, I went the wrong way. That is, oh, no. There we go. And that is to go to a wonderful source at the U.S. Census Bureau called the American Community Survey. Now, the Census, of course, does their decennial census, what we're gearing up for next year, where they try to tabulate information on every person who lives in the United States. But in between those censuses, they do surveys of people. And, of course, it's survey information, so it's not a census, and so there's some error around it, or a range that the numbers could actually be. But still, it's pretty good, and they do subsets. They do states. They do counties as well. And so American Community Survey, the data you get on their website, I find the data a little bit hard to use, a little bit hard to extract, but once you get the hang of it, you can usually find what you're looking for. And what I was looking for was average, or in this case, median property tax payments. And it turns out from the American Community Survey that Indiana's median real estate tax by homeowners was $1,214, and that's 44th highest in the U.S., or in other words, 7th lowest in the U.S. Our property taxes are really low. So that's one way to do it. You could go into the American Community Survey and come up with this property tax number. Thing is, though, that's not a rate. That's a dollar amount. And property tax rates are measured against the value of property. Well, yes, assessed value of property, but you can get the median value of homes from the American Community Survey as well. And if you divide the real estate tax by the median value of homes, the rate comes up to be 0.82%, which is 30th highest in the U.S. So by that measure, we're not particularly low. We're kind of in the broad middle among states in Indiana. And I'll try to lean out a little bit here. Apparently I'm a little loud.
Don't tap the desk.
Oh, don't tap the desk is what Tamara is telling me. That looked like a lower your voice sign, so sorry about that. I will try not to tap the desk. So how should we do this? Should we look at the dollar amounts? Should we look at a rate as a share of the market value of homes, or the sales value of homes, which is what the census is measuring? Of course, there's the assessed value of homes, which is less than the market value of homes. That's why the 0.82% looks like a low rate. But remember, our assessed values are less than half of our market values. And then what about property taxes on agriculture, on rental housing, on business property? Property taxes on homes in Indiana are less than half the total of property taxes, and so the American Community Survey would miss that. I'd also like to point out, you know, why is our dollar amount 44th highest, but our percent of home values 30th highest? Is because home values in Indiana are low relative to the rest of the country. And you only have to watch one of the cable home improvement real estate flipping shows to know that a ranch home, 3-bedroom, 2-bath ranch house that would cost, you know, $120,000 in Indiana will cost $500,000 in California. And so you've got these differences. Does it make sense to say that $12,014 is a lot of money in Indiana and not much money in California? Well, I don't think, in fact, that does make sense. And what that comes down to is the fact that we pay our taxes, no matter what tax it is, we pay our taxes out of income. We don't sell off a piece of property in order to pay our property taxes. We pay it out of income. Sales taxes are measured based on what you buy, but we pay those sales taxes out of our income. Property taxes are based on property values, but we pay those taxes out of income. And so the rates, of course, are going to be based on the particular tax base. We pay it out of income. So maybe we should measure these things against income. And in fact, that's what I'm going to do here. The data source I'm going to use is a very nice data source, again from the U.S. Census Bureau, that doesn't get the publicity it deserves, I think, and that's the annual survey of state and local government finances. So every year, the Census Bureau goes out and collects information about taxes and spending from every state and from a subset of local governments. So it's a survey, of course. Every 5 years, they do a census of governments. So in years ending with a 2 and a 7, they do a census of governments. But the survey takes place every year, and this is nostalgic for me because I studied state and local government policy in graduate school, and even back then, and that's getting to be a long time ago now, late 1970s, even then we were using state and local government finances. In those days, it came out as a hard copy, a kind of magazine, and even then the data went all the way back to the early 1960s. So we've got 50, 60 years worth of this data on state and local government finances from the U.S. Census Bureau. The most recent, the drawback is the most recent data is 2016. It takes them a couple, 3 years to assemble all of these numbers. So we're going to have to depend on 2016 data. We're going to take income from the Bureau of Economic Analysis, that's Department of Commerce, another agency in the Department of Commerce, and their regional income accounts. And so they give us state income totals, or wages, interest, rent, and profit added up for each of the states. So what we're going to do is divide the tax revenue by income and come up with a kind of tax rate. What percentage of our incomes do we pay in total to state and local taxes, and what percentage of our income do we pay to each individual tax on average across each state? The other thing that the Survey of State and Local Government Finances does that helps with this kind of analysis is they sum all the state and local taxes into standard categories. They have standard definitions of what do they mean by property taxes, what do they mean by income, what do they mean by sales. And of course the states all define these things as they will, their own histories, their own preferences, and their own legislative decisions that they've made. And so comparing across states with state data is sometimes very hard because what is a property tax in Indiana may not be a property tax in another state, for example. But the census takes care of that by creating standard categories and making the data among the various states comparable across states. Okay, with all that introduction, let's take a look at some results here. And I'm going to map out the results. First, because it makes a pretty picture, and second, because it gets us a kind of geography of taxation, and there are some regional patterns in taxation. So what we have here is state and local taxes, total state and local taxes as a percentage of income in 2016. And I've made a value judgment here. You know, I've used the traffic light colors here, green, yellow, and red. And I've made green mean lower taxes, and I've made red mean higher taxes. And, you know, you got to decide one way or the other how you're going to do this. And since people tend to like lower rather than higher taxes, as long as you provide enough revenue for the services that we need, that's what I've done. But so take that with a grain of salt if you disagree. But at any rate, what do we got? We've got Indiana in the light green category, 8.5% to 9%, and nationwide, that ranks us as the 34th highest taxes. And so we're right on the border of the lowest third of taxes in the country. And if you take a look at the pattern, what do we see? We see New York and New England the upper Midwest and California and Hawaii with the highest taxes. And we see the lowest taxes in the South and in the mountain states. This is a pattern. I think we kind of recognize this pattern as something that we realize. And what it means is that Indiana is kind of more like a southern or a mountain state than it is like a typical Midwestern or Northeastern state. And I think this is something that's been observed about Indiana over the years, is that while we're smack in the middle of the Midwest, we were kind of settled from the south to the north. And so we have quite a bit in common in the way we organize our local government, our state government, our taxation, as well as other aspects of our lives. A little bit more in common with the southern states than we might with Michigan, Wisconsin, Illinois, or Ohio. And that's evident here, the state and local taxes as a percent of income. So Indiana, a relatively low tax state, but definitely not rock bottom. Here's property tax. This property tax is a percent of income. Again, not as a percent of value of property, but as a percent of income, since we pay our property taxes out of income. Indiana, again, low, light green here. And if we look at the ranking, we're 42nd highest. And so we're in the bottom 10. The percentage for Indiana is actually 2.2%. And so we don't make it in there with the very lowest dark green group there, but we're low. We have very low property taxes in Indiana, and we saw that from the American Community Survey data as well. And again, that makes us more like southern states. And here, in fact, you see some very long-term historic patterns. If you take a look at New York, New Jersey, New England, that's where the high property taxes are. Well, those were among the original colonies up there, the original states, and the property tax is the oldest of our taxes, and the New England states, New York, New Jersey, kind of organized from the bottom up, right? The New England town meetings, you get together and you set your tax rate and you decide what services are going to be provided, and it's very much bottom up, and the property tax is a local tax. And so if you're going to run your governments from the local level, you're going to use a local tax, and the property tax is that tax. You go south to the original southern states, and you see generally low property taxes. And, well, the southern states were kind of top down. And so property taxes not used as much in those states, and still not used as much in those states. And once again, Indiana more like a southern state than like Michigan, Wisconsin, Illinois, let alone New York, with the higher property taxes. So again, Indiana with a low property, a really quite low property tax state. Sales taxes. So these are the general sales taxes, our 7% general sales tax across the board. And in this case, we're a little bit high, right? We've got, we're colored red there, and we're 19th highest. And this one's in contrast to the property tax. You look up at New England, and you see that their sales taxes tend to be low. You look to the south, and you see that their sales taxes tend to be high. And that's really just the flip side of the property tax. If you're not using a sales tax, or if you're not using a property tax, I should say, if you're not using a local tax, maybe you'll use a sales tax, a statewide tax. And certainly you look at Tennessee, Mississippi, Alabama, Florida, Arkansas, Louisiana, Texas. These are places where the sales tax is relied upon. So Indiana's ranked 19th highest in terms of percent. So we're not at the tippy top on sales taxes, but we're in the top third. Actually, not quite in the top third, are we? We're in the broad middle, but towards the top third in general sales taxes. In this case now, for the first time, we see the dark green means no tax at all. And there are 4 states without general sales taxes. Oregon, Montana, New Hampshire, and Delaware don't have a general sales tax. That's a possibility. That's not true with property tax. Everybody's got the property tax. Everybody's got some taxes, of course. But there are 4 states without a general sales tax. How about income taxes? And here the pattern, Indiana, not so much like either the North or the South in this case, because we're smack in the middle. We're in that 2 to 2.5% range, along with Michigan and Illinois. But most of the states surrounding us tend to be high. Ohio, Wisconsin, Iowa, Kentucky have particularly high income taxes as a share of income. The Northeast, Mid-Atlantic, West Coast, Oregon and California, anyway, tend to rely on income taxes more, so they have higher income tax rates. And the southern states, a little bit less on the income tax. And then, once again, we've got several states without income taxes. We've got Florida and Texas and South Dakota and Wyoming and Nevada and Washington and Alaska that don't have any income taxes. Indiana, of course, has state and local income taxes, which gives me an opportunity to take a little side trip here and show you, well, before we do this, we've got Indiana with the 34th highest income taxes. So, again, on the cusp of the lower third here. So Indiana in the broad middle, but getting a little bit low on income taxes. So somewhat lower rates, even though we're ranked in the broad middle. Here's the side trip, though, and these are the states with at least 5% of income or sales tax revenue from local governments. Now, Indiana has local income taxes, and if you look at our region, you might be forgiven, Indiana folks might be forgiven for thinking that local income taxes are really fairly common, because Michigan has local income taxes, Kentucky has local income taxes, Ohio has them, Missouri has them, Pennsylvania has them. In our region, local income taxes are pretty common. But if you look across the country, right, there's only 9 states altogether that have any local income taxes or any sizable local income taxes with at least 5% of their total income tax revenue levied on the local level. There's 4 states that have just local income taxes and 5 that have both local income and sales. But there are 32 states that have local sales taxes, 27 that have just local sales taxes, and 5 that have both. So 32 states with local sales, 9 with local income. Local sales taxes much more common across the country than local income taxes are. And in this sense, we are very much not like the South, right? Where are the local income taxes? They're mostly in the Midwest and the Northeast. Where are the local sales taxes? Well, basically everywhere else in the South and the Great Plains and the Mountain and the West. So Indiana here went for local income taxes, unlike most of the rest of the country who went for local sales. Corporate income taxes, first thing to do with corporate income taxes, take a look at the tax percents in the legend down on the lower right, and you can see these numbers are quite low. The corporate income tax is kind of next level down, an order of magnitude lower in the amount of revenue that it raises compared to property, individual income, or sales taxes. And Indiana's kind of in the middle. We rank 18th highest, and so we're we're right about actually near the top third, but not quite in the top 1/3. So our taxes are kind of in the middle for corporate income taxes. Of course, our corporate income taxes are going down. We are in the midst of a long-term reduction in our corporate tax rates. We're surrounded to the west and south by places that have high corporate income taxes, but to our east in Ohio, they have low corporate income taxes, and Wisconsin and Michigan are kind of in our same boat. I frankly don't see much of a regional pattern here. I guess Northeast a little high, mid-south, Texas, Oklahoma, Louisiana a bit low. A lot of places that are in the broad middle. It's also the case that the range in corporate income tax rate is not very wide. So to be near the top, your difference from the middle is not so great. To be at the bottom, the difference from the middle, not so great. Although there are, as you see again, several states that do not have corporate income taxes. Texas, Wyoming, Nevada, and Washington do not have corporate income tax rates. Finally, we've got everything else. And so I've lumped together the selective sales taxes, and so this is motor fuel, tobacco, gambling taxes, alcoholic beverage taxes, and then the taxes that are on motor vehicles, and then everything else that might be included as a percent of income. Indiana, kind of low here, 40th highest, so we just make the bottom 10. We look around and see that Wisconsin, Michigan, Ohio in the same boat as we are. Illinois, Kentucky a little bit higher in their reliance on these taxes. But the pattern, well, we're all over the map, to coin a phrase. You look out west and you've got states that are very low on these taxes and states that are very high on these taxes right next to one another. You've got a whole bunch of states right in the middle towards the south and in the northeast, although everywhere has got some that are high, some that are low. So we're all over the map, as you might expect with a category that slaps together a whole bunch of different kinds of taxes. Okay, so we've looked at these 5 major categories of taxes. What's the pie look like? And here it is. These are the shares of the 5 major taxes in Indiana and in the United States. And as you might have guessed, both from the data that's shown you on these maps and from Indiana's history, Indiana is low on our reliance on property tax and high on our reliance on sales taxes. 25% of our state and local government revenue comes from property taxes. Nationwide, it's 31%. 28% of our state and local revenue comes from sales taxes. Nationwide, it's 24%. So we are heavy on sales, light on property relative to the United States. Well, that's our history, right? If you consider what we've been doing for the last 45 years, 3 times in the last 45 years, we have increased the sales tax specifically to reduce the property tax. Back in 1973, we increased the sales tax from 2% to 4%. Can you imagine a time when the sales tax was 2%? Increased it from 2% to 4% and took that money and used it for what were called property tax replacement credits, which reduced property taxes by 20% across the board. So we specifically replaced property taxes with sales taxes. And then in 2002, in response to the reassessment of that, the market value reassessment that we had, we raised the sales tax from 5% to 6% and used about half of that money to provide tax credits, homestead tax credits, property tax credits to property tax payers, to homeowners. And then in 2008, we did it again. We raised the sales tax from 6% to 7% and used that money to replace, used it in state aid, state school aid, to replace the property tax for school general fund as a way to reduce property taxes. So 3 times in the last 45 years, we've increased the sales tax to reduce the property tax. It's no wonder that we're high on sales and low on property. We're also a little high on income, as you can see. 26% of our state and local revenue comes from income taxes. 24% is the average across the country. And that goes back to the fact that we use local income taxes and most states do not. So that's what the pies look like. Now, I couldn't resist, and so I'm going to do something technical here, but I think it's revealing and can lead into a discussion of what kind of criteria do we use to evaluate taxes. And here it is. This is a bar chart. Now, I know you can't see, probably can't see the names of the states, and if you can, well, congratulations on having a big high-resolution screen, but I'll tell you the important ones here in a minute. What this is an index of tax revenue balance, and forgive me, I got to tell you how this is done because I think it's cool. This is called a Herfindahl index. It goes with, under other names as well, but a Herfindahl index. And what you do is you take the shares of each tax in the total, so 0.25 for the property, 0.28 for the sales tax in Indiana, and you square it, and then you add up the squares. And if you think about it, if you had a state that used just one tax, that is 100% for one tax and 0% for the other 4, and you squared it and added it up, it would add up to 1, right? You'd square 1, and that would be 1, and then you'd square 0, 0, 0, 0, and that would be 0, and you'd add it up and add up to 1. And so if you've got a completely unbalanced tax system, the index will be 1. And as it turns out that if you had a completely balanced, that is, every tax was 20%, every tax was 0.2, the number would add up to, as it turns out, 0.2. And so this is an index that ranges from 0.2 to 1. And if you rank them, as I've done here, you can see which tax systems are most balanced and which ones are least balanced. And here's the U.S. average. And you might think it's odd that the U.S. average would be towards the top. Usually the average is somewhere in the middle, right? But in this case, it makes sense because what we're doing here is sort of ironing out all the state's quirks when we add it all up, right? You might have one state that's heavy on the sales tax and another that's heavy on the property and another that's heavy on the income. When you add it all up, you get something that looks pretty balanced. And so the United States itself, the total is in the top 10 of balance. Where's Indiana? Indiana is third in tax revenue balance. Well, number one is the District of Columbia, and if you don't want to count the District of Columbia, that makes us second only behind Pennsylvania in most balanced tax system. All right, so how can we be most balanced when we spent 45 years moving from the property to the sales? Aren't we a little high on sales? Well, we are high on sales, but we were, in fact, unbalanced. All those moves from property to sales improved our balance, moved us up this scale. Those states that haven't done that are lower on the scale. Where are our neighbors? There's Kentucky. So Kentucky's also in the top 10, just a couple of spots below Indiana. But there's Wisconsin, Illinois, Ohio, and Michigan, kind of in the upper middle range, right? They're still relatively low on the scale, but quite a bit lower in terms of balance than Indiana and Kentucky. And they are unbalanced in different ways. Some of them a little heavier on property, some on sales, some on income. I can't help but show you you'll notice at the very bottom there's one state that is extremely unbalanced, and that happens to be New Hampshire. You know, they're at least a whole tenth of a point higher than the next lowest state, so New Hampshire. So let's take a look at their pie chart to see what makes them unbalanced. And here it is. 65% of the state and local tax revenue in New Hampshire comes from the property tax. They don't have a sales tax at all, and their income tax raises only 1% of their revenue. So they virtually don't have an income tax either. So they're extremely heavy on the property tax. This is the least balanced tax system in the whole United States there, New Hampshire. Now, do we care? Is there any reason to think that being more balanced is better as a criteria for taxation than being less balanced? And there are a couple of reasons that might make balance beneficial to a state. First of all, consider a portfolio of taxes. Suppose your taxes, your revenue sources are a kind of portfolio, like your portfolio of investments. And when you put together a portfolio, you want a lot of different kinds of tax. You want some that are high risk, some that are low risk, some that will grow fast but might be risky, some that will grow slow, that might be less risky. And you do that so that if one sector of the economy gets in trouble, your whole portfolio won't tank. Well, same thing to some degree with taxes. Right? If you've got some in sales, some in income, some in property, some in excise, some in severance if you've got any mining or extraction industries, some in gambling maybe, it's possible at least that when a recession hits and income goes down, maybe the property values don't go down, or at least not as much, or at least not right away. Maybe there's parts of the property tax that wouldn't go down. This most recent recession, farmland values continue to go up, and so the property tax didn't decline as much as sales and income taxes did. So it's possible that you might have a portfolio effect if you've got a balance of taxes among different sorts of taxes. Now, problem is portfolio works better if the components of your portfolio aren't correlated with one another, and of course all the taxes are correlated with one another. Income goes down in a recession, and so does sales, and so do property values. So it doesn't work that well with taxes, but there's at least something to that. The other and perhaps more important aspect of balance has to do with the idea that what you want in a tax is a low tax rate on a broad tax base. And we're going to run into this idea a lot as we evaluate taxes. So let me take a little bit of time here and explain what this is all about. This has to do with what economists call distortions. And so the first thing to do is to imagine a place with no taxes. All right, so how do they pay for their local government, state government services? I don't know, imagine somebody else is paying for it, right? So we're just imagining a place that has no taxes. If there are no taxes, people decide what to spend and what products to buy and what to save based on their incomes and the prices of products and their needs and their wants and their tastes and their preferences. That is, they make their ideal choice. They maximize their well-being. They achieve the highest well-being that they can. And the economists like that. We tend to think the choices that people make before the taxes are imposed, those would be the best choices that they can make. Those are the choices that maximize their well-being. Those are their ideal choices. Well, now, we got to have taxes, right? Taxes are inevitable, and we have to, death and taxes are the two inevitable things, and so we have to have taxes to pay for public services. And that's going to reduce their well-being. We're going to take some income away from them. They're not going to be able to buy as much stuff, not going to be able to save as much. That's going to be reducing their well-being. That's inevitable. But there's more to it than that. Suppose the tax we have is a sales tax, and suppose to pick a rate that it's a 6% sales tax. And suppose, though, that the tax is just on goods, not on services. And that's true across most of the country, generally, that the sales tax taxes goods, tangible products, and not services. Well, if we do that, we have raised the prices of goods, but not raised the prices of services. And the way people make decisions is they tend to move away from high-priced goods towards low-priced, or high-priced products towards low-priced products. So what we've done now is distorted people's choices. They're buying fewer goods than they would ordinarily buy and buying more services than they would ordinarily buy. We've knocked them off their ideal choice. They are no longer making purchase based on their highest pre-tax well-being. Now, they're maximizing their well-being post-tax, but the taxes themselves are influencing what they're doing. They're making their choices based on the tax code, not based on what would be best for them. And these are called distortions. And, economists hate those, right? Because we think that people's well-being are what they would choose before the taxes are imposed. And here we're not only subtracting from their income, we are distorting their choices even before that. Now compare that to a sales tax that is imposed across the whole tax base. And since goods and services are about 50-50 among our spending, that would mean that you could impose the tax at 3%. 3%, a lower tax rate over a broader tax base, includes both goods and services. Now you've eliminated that distortion because all of the prices of the goods and services have increased proportionately. The relative prices between goods and services now have not changed, and that price distortion you created before is now gone. Not only that, but if tax rates are particularly low, now 3% may still be too high, but if tax rates were particularly low, people might just ignore them. They might make their decisions based on their ideal choices, based on their maximized well-being, and ignore the taxes altogether. If they're low enough, that might happen. So what are we saying here? We're saying low tax rates on a broad base can minimize the distortions created by the tax system and allow both people and businesses to make their ideal choices and either maximize their efficiency for businesses or maximize their well-being for households. So that's what we're talking about when we're talking about broad base, low tax rate. And if you've got a balanced tax system, that probably means you've got a broad base. If you've got a broad base, you might have relatively low rates, and that might minimize distortions. Okay, let's keep that in mind as we move forward, because now we want to evaluate taxes. Okay, balance is one way to evaluate taxes. It's probably not high on the list of the criteria you'd like to have in your tax system. So let's look at 4 characteristics of tax systems that we might use to evaluate taxes. And here they are. First of all, administrative costs. Well, this one's pretty obvious, I think. You would like the revenue you collect from your taxes to pay for goods and services, to pay for government services delivered to the taxpayers, not to pay the cost of actually collecting the tax. We do the same thing with charities, right? We prefer a charity that actually delivers the money to the stuff that we're trying to contribute to, not to paying the salaries of the people who collect the money for the charity. And so this is true for taxes as well. So we would like to have taxes with low administrative costs. Let's point out that, yes, administrative costs can accrue to the government. Property tax, for example, we have to have an assessor in order to measure the tax base, in order to measure the value of property, and that's costly to the government, makes the property tax costly to the government. But that doesn't mean it's necessarily less costly than the income tax, because the income tax, we make the taxpayer value the tax base. We make the taxpayer figure out what their taxable income is. And is that costly to people? Oh boy, yes it is. That's a major industry providing tax services to taxpayers. And so the costs, administrative costs, might accrue to the government, might accrue to taxpayers, but we would like those costs to be low if at all possible. So low administrative costs, that's one thing we'd like to see in our tax system. Stability and growth. Recessions come along, and you know what? We may be in recession, but we still got to fund the schools. We still got to fund the police and the fire protection and the parks and the roads. We would like revenue to be stable in recession, if at all possible. When we have inflation, the prices that state and local governments have to pay, the wages that state and local governments have to pay, they go up. And we would like the revenue to keep up with inflation. And then population grows. And as population grows, there's a greater demand for public services from our state and local governments. Let's have the revenue increase as population grows as well. So you'd like stability, you'd like growth, you'd like revenue sources that don't fall very much with recession, do rise with inflation, and do rise with population growth. Stability and growth is another category, another criteria for evaluating taxes. But it's these last two that I really want to focus on, partly because, well, they're important certainly, but also because they create a kind of trade-off. And it's a trade-off that I want to spend a good deal of time looking at here in the rest of our talk. And those two are economic development and equity. We would like a tax system that encourages business investment and employment, or at the very least, does not interfere with private decision-making. So this is where the broad-based, low-rate idea, non-distortionary thing comes in here with economic development. We would like a tax system that doesn't discourage businesses from locating, investing, expanding in our state. And certainly that's been quite the effort in Indiana over the recent decades, really. Let's see if we can't create a tax system that is business friendly, that can create economic development, foster economic development, allow job creation, and all of that good stuff. So economic development, very important criteria for evaluating taxes. But then there's equity. And equity, of course, sounds, when you even say it out loud, sounds like a value judgment, right? Equity's in the eye of the beholder. But we can identify really two major ways of evaluating equity, and one is the benefit principle, and one is the ability to pay principle. And even though I got listed second, let's do ability to pay. Ability to pay means taxes should be based on income levels. You know, how much income you have. You've got more income, you've got a greater ability to pay. Maybe you should pay for more of the tax burden. If you've got a lower income, you've got a lesser ability to pay. Maybe you should pay for less of the tax burden. At the very least, I think folks would say, hey, we would like to have a tax system that at least doesn't promote income inequality. At the very least, leaves income inequality where it was before the tax system came along. And at best, for those who have this value, would like to see it lessen income inequality. So ability to pay, income inequality related. What impact does the tax system have on inequality, on equality of incomes across our economic system? But there's another way of evaluating equity, and that's the benefit principle. And that's taxes based on services received. So which measure of equity should we use? It's your choice, basically. I think a lot of people, and I guess I count myself as one of them, keep both of these in our heads at the same time, even though they sometimes conflict. But the benefit principle basically says, hey, if you receive the services from the local government, you ought to pay for them. And there are certain services for which we adhere to this idea rigorously, and let me point out that in Indiana, we want to use the benefit principle for roads. Gosh darn it, we think drivers should pay for the roads that they drive on. And we bend over backwards to figure out ways to get the drivers to pay for the road maintenance and road construction. We say, hey, let's have motor fuel taxes. Let's have excise taxes on motor fuel, diesel, and gasoline. Let's, as we did recently, carve out a part of the sales tax that's paid on gasoline and devote that to roads. Let's take registration fees, even invent new registration fees on vehicles and use that for roads. Let's put tolls on the bridges and use that for roads. And you know, as electric cars become more common and they don't pay for gasoline taxes, maybe we'll start using tolls for the roads as well. At least we're looking into that possibility. Great effort made in Indiana to have drivers pay for roads. And if you think about it, that wouldn't have to be. Even if you're not a driver, you benefit from roads. If you go to the grocery store, how do you think the food got to the grocery store? Well, it came in trucks driving on roads. Even if you're not a driver, you're benefiting from those roads. There aren't grocery stores on railroad sidings or with airport runways, and especially in Indiana, no grocery stores that have ocean ports, right? So you could justify using general sales or income taxes to pay for roads, but in Indiana, we don't. We have a narrow definition of the benefit principle: drivers should pay for roads. So that's an illustration of the benefit principle in Indiana. Okay, now here's what I'm going to do. I'm going to find a group, an organization out there that believes, that has made the value judgment that the most important thing about taxes is economic development. And I'm going to find another group, another organization that has made the value judgment that the most important thing about taxes is equity. And those two groups are the Tax Foundation and the Institute on Taxation and Economic Policy, known as ITEP. Okay, so let me say this right now. I'm going to try very hard not to endorse either of these value judgments. We are studying these organizations, and we are studying their opinions, and we are not backing either one of them. So let's make that very clear, because the conclusions the Tax Foundation and ITEP come to very much depend on what they think is important about taxes. The Tax Foundation thinks economic development is important, and so they do a business tax climate index. They rank the states based on how friendly their tax systems are to businesses, to business investment and expansion, to business operation. That's a value judgment, but there it is. We found an organization that does a ranking based on that judgment. And then ITEP does a ranking based on whether or not the tax system, the state or local tax system, promotes inequality or lessens inequality. And so they're very much concerned with how does the tax system treat low-income people as compared to high-income people? Does it help the upper-income folks? Does it help the lower-income folks? That's the value judgment they have made. And the reason for selecting these two organizations is that you see the cover pages here of the two reports that they come out with every year. The Tax Foundation's report is 81 pages long, and the ITEP's report is 141 pages long. These are substantial efforts, and they are transparent. They tell you exactly how they are making these measurements. And if you read their publications here, they are well done. That is, they adhere to academic views about how should you measure business climate, how should you measure tax equity. Now, the academics are not settled on these two issues. There are controversies about how to measure tax incidence, as it's called, how to measure who pays. There are questions about whether taxes matter very much for business location at all. But these two organizations tell you how they do it. They do it in standard, academically accepted ways. These are clearly groups that employ experts to make these judgments. And yes, they are judgments in support of particular value judgments, but they are very well done in support of those value judgments. So Let's start with the Tax Foundation. And here's a quote for what they think they are doing. Taxation is inevitable, but the specifics of a state's tax structure matter greatly. The measure of total taxes paid is relevant, but other elements of a state tax system can also enhance or harm the competitiveness of a state's business environment. State Business Tax Climate Index distills many complex considerations in an easy-to-understand ranking. That's what they're after. And complex is right. What they do is they rate 5 different taxes: individual income, corporate income, sales, property, and the unemployment insurance taxes. This is the only time we're going to mention those. But they rate 5 taxes on a 0 to 10 scale based on 118 tax rate and tax law characteristics. So these folks are experts on business taxation. And if you want to learn a little bit about business taxation, excellent place, excellent publication to go to see what are the various elements of business taxation that businesses might be concerned about. This is taxation as of July 1st, 2018. This is their most recent report. So they're going to take 118 characteristics, rank them from 0 to 10. All right, Indiana. How do they rank Indiana on each of the individual taxes? Individual income tax, 2019 rank 15th, unchanged from 2018. So they pretty much like Indiana's individual income tax. What is it they like generally about income taxes? And here's the quote: states that do impose individual income taxes, well, that's a loaded statement. There are several states, as we saw, that don't have individual income taxes. The Tax Foundation loves that, right? If you think about it, if you don't impose a particular tax, all of the distortions that could emerge from that tax are absent. And boy, that raises you in their eyes. They rank all of these elements of the taxes from 0 to 10. If you don't have a tax, you get the perfect 10. So states that do impose the individual income tax generally score well if they have flat, low tax rates with few deductions and exemptions. Well, what is that? Low taxes without deductions and exemptions, broad base. Right? They're going for that non-distortionary, low tax, broad base system. States that score poorly have complex multiple rate systems. Oh, they really don't like the graduated rates that have lower taxes on low income folks and higher taxes on high income folks. So what do they like about Indiana? They like Indiana. What do they like about Indiana? They like our flat tax rate. We don't have a graduated tax rate. We got a flat tax rate. And even though we have local income taxes, our state rate at 3.23 plus our local income taxes, still among the states with the lowest overall rates. So that's why they like us. About the corporate income tax. Well, 2019, they ranked us 18th, and we improved 6 spots from 2018. So we are getting much better in the Tax Foundation's Business Climate Tax Index based on our corporate income tax. Well, of course, we're reducing our corporate income tax rates. And as I say, states that do impose corporate income taxes, again, if you don't have one, they really like that, generally will score well if they have a low rate, and our rate's getting lower. And states with a high rate or complex or multiple rate systems, graduated rates that tax big corporations more, score poorly. They don't like that either. So again, a flat rate tax, that's what we have in Indiana. Our rate is 5.75%, which is 13th lowest, and it's going down by 2022 to 4.9%. That's already in law, already scheduled to happen. And the Tax Foundation said about Indiana for 2018, corporate income tax rate declined from 6 to 5.75. This rate reduction, among other changes, drove an improvement of 6 places on the corporate component of the index. So if that 1/4 point change raised us 6 places, if we go down by another almost full point, as we're going to, we should be definitely in the top 10 by the time we're done on the corporate income tax rate from the Tax Foundation's point of view. Sales taxes, we rank 12th. Even though we've got a high rate, we rank 12th. Down from, but we're down, actually. We're down 2 points, two spots. We were 10th, and now we're 12th. What do they like among the states with a sales tax? Those with low general rates and broad bases, which avoid tax pyramiding, do best. Okay, here's another term, tax pyramiding. What are they talking about here? These are business-to-business taxes that create tax pyramiding. Now, usually it is said that if you want a sales tax, the tax that you want is a tax on consumer goods, the goods that are sold directly to consumers. If you tax business-to-business taxes, you get what's called tax pyramiding. And let me give you an example. This is an example I use in class, my economics class, but for a different purpose. But imagine a farm growing corn, selling that corn to a corn sweetener company, factory, and that corn sweetener produced and then sold to the cola bottler, who then makes the cola and sells the cola to the consumer. If you've got business-to-business taxes on all transactions, you will have applied the tax to the sale of the corn, to the sale of the sweetener, and to the sale of the cola. You will have taxed it 3 times. That's tax pyramiding. Right? And this is a problem for a number of reasons. One is it makes the sales tax non-transparent. Sure, the consumer sees the 7% tax on the cola, but doesn't realize that the price of the cola also includes the tax on the corn and the tax on the sweetener. So it's non-transparent, understates from the consumer's point of view what the tax actually is. Worse than that is the distortions it creates. What it does is to raise the price of products that go through many stages of production relative to products that go through only a few stages of production. So the cola will have been taxed, at least pieces of it, taxed 3 times, but the sweet corn sold directly to the consumer is only taxed once. So we're raising the prices on products that go through many stages of production. And you really can't think of a reason why we should do that. That's just an artifact, an accident of pyramiding, and there's no policy reason to do that I can think of at any rate. But even worse than that, consider a business that owns the farm, owns the sweetener factory, and owns the bottler. They raised their own corn, shipped it to the sweetener, shipped the sweetener to the cola bottler, and then sold it to the consumer. It got taxed by the consumer on the consumer level, but all those internal business transactions were not taxed. If you had separate firms selling to one another, they were taxed. So what's your distortion here? We're distorting in favor of bigger business and what's called vertically integrated businesses, businesses that own stages of the various stages of production. So now we've got something that's, in a sense, anti-competitive. We're favoring big business and oligopoly or monopoly instead of competitive small business. Oh boy, we really don't want to do that. And so those are the problems with pyramiding. And so business-to-business taxes, tax foundation doesn't like those much. Tax features for Indiana, sales tax rate is 7%, second highest among states, but Indiana does not have local sales tax rates. And so our rate is actually not that high, not at the very top when you add them all up. States like Indiana achieve high scores because they're tax-based by avoiding the problems of tax pyramiding, not much in the way of business-to-business, and adhering to low excise tax rates. So they lump together the alcoholic beverage and gasoline taxes in there with the sales tax. And they also say something very curious. The 5 states that fully include gasoline in their sales tax base, Alaska, Hawaii, Illinois, Indiana, and Michigan, get a better score. Now, a lot of times you look at this and say, well, isn't that double taxation? You know, we got an excise tax on gasoline and a sales tax on gasoline. I guess it is, but it's also a broad base, a broader base for your sales tax. Because it turns out gasoline is a pretty big chunk of the total sales tax. And so, again, Tax Foundation likes that broad base. And so our sales tax gets that high rate. Why did we fall by 2 spots? I suspect it's because our motor fuel taxes went up recently. And that probably knocked us down from 10 to 12. Property tax. Oh my gosh, does the Tax Foundation love Indiana's property tax? We rank 2nd, and we're up from 4 to 2nd in 2019. Why do they like it? Well, what are they looking for in a property tax? When properly structured, property taxes exceed most other taxes in comporting with the benefit principle and can be fairly economically efficient. Why is the property tax good as far as the benefit principle? Well, if you own property, you got the police protecting your property, you got fire protection protecting your property, you've got roads leading to your property. And we pay for all those local expenditures with the property tax. In a sense, a tax on the value of property pays for the local government services that protect and enhance the value of that property. That's not to mention schools, which, if you have a good school system, people will move in, increase the demand for your property, and increase your property values. So a lot of reasons to think that the property tax can be viewed as a kind of benefit tax. What else do they like about Indiana's tax? Relatively low property tax average and percent of income, as you can see. And then we don't have a whole list of property type taxes that the Tax Foundation thinks introduces distortions. No intangibles tax on stocks and bonds, no inventory tax, we got rid of that 10 years ago, no real estate transfer tax, no inheritance tax, no gift tax. Only 10 states in the whole country have none of these taxes, and we're one of those. They say of Indiana, generally have low tax rates on property tax, whether measured per capita or as a percentage of income. Also avoid the distortionary taxes, inheritance, gift, and other wealth taxes. So that's why the Tax Foundation likes our property tax. In total, add it all up, 118 things combined into a single index. Indiana's got the 10th best tax climate in the country, according to the Tax Foundation. Why? Low rates on broad bases, flat rate individual and corporate income taxes, and our declining corporate income tax rate. Tax Foundation likes Indiana. The folks who value business climate, who value economic development, say that Indiana's tax system is a good one under that criteria. Now let's look at the group that talks about, thinks about, worries about tax inequality. That's ITEP, and they publish who pays. And what are they after with their index? They say the ITEP Inequality Index helps answer the question, are incomes more equal or less equal after taxes than before? It accomplishes its goal by comparing incomes at various points throughout the income distribution, both before and after state and local taxes are collected. All right, so the Tax Inequality Index compares after-tax to pre-tax incomes among upper and lower income groups. They look at the sales, the excise, the property, the individual, and the corporate income taxes. They've got tax changes through September 10th, 2018. They have to use IRS data for this, and the most recent IRS data at the time they published this was from 2015. So they're taking the tax changes, the tax systems of the states from 2018 and applying them to income, sales, and property data from 2015. So it's kind of a disconnect there, and that's a little bit of a problem. I don't think it undermines their ranking, but it is something to at least be aware of, that the dates don't match up there. But what else are you going to do? In order to do this sort of thing, you got to use the data as it's available, and that's what's available. All right. What does ITEP, what do the equity people think about the sales tax and Indiana sales tax? The sales tax, says ITEP, is the most regressive tax. And by regressive, they mean it hits low-income people more than higher-income people. As a share of their incomes, low-income people pay more to the sales tax than do upper-income people. And here's the reason. It's because sales tax taxes spending, but doesn't tax savings. Lower income people spend most of their income. Of course, they have to. Their low income barely pays for the necessities of life. They have to spend it all. But upper income people, they can save. But savings aren't taxed by the sales tax. So the fact that upper income people save and lower income people can't means that the sales tax hits lower income people. It taxes all of their income, or at least potentially can tax all of their income, and doesn't tax all of the incomes of upper income people. That creates the regressive tax. Exemptions do matter. In particular, are necessities exempt? ITEP prefers if you exempt food, because food is a larger part of lower income people's budgets than it is of upper income people's budgets. You can only eat so much. What does ITEP like or dislike in Indiana? Indiana ranks 16th among states in reliance on sales taxes. That means that, well, we have moved towards sales taxation over the last 45 years. ITEP doesn't like that much, but they do appreciate the fact that we exclude groceries. Well, here's the scale. Here's what they do and show for Indiana. And this is what they're measuring. If you look at the scale across the horizontal axis, they've divided up family incomes in Indiana and everywhere else into quintiles. That is the lowest 20%, the middle 20%, and then the upper 20%, which they then subdivide into 15, the top 4, and then the top 1%. And because as it turns out, over the last couple of decades, what has happened within the top 20% is different. The top 1% has fared differently than the next 4% and the remaining 15%. And this is a picture of regressive taxation. The lower 20%, since their spending is being taxed, they pay a higher percentage of their incomes to the tax. The upper folks pay a lower percentage because they save so much. So the sales tax, a regressive tax. ITEP doesn't like Indiana very much because we rely so heavily on the sales tax. What about the property tax? Property taxes, as you might guess, property taxes are the complicated one as far as figuring out tax incidence. Property taxes are thought to be somewhat regressive. And there's a number of different things going on here with the property tax. Certainly, upper income people own more property than lower income people. The Federal Reserve does a survey every 3 years about the distribution of wealth, and boy, upper income people own a great deal of wealth, including the property. Wealth is less equally distributed than income is. And in particular, upper income people own more business property. Now, a lot of the property that upper income people own isn't taxed, right? Intangible stocks and bonds don't get taxed by the property tax. But upper income people do own more of the business property. So you might think property tax might have a progressive element in there. Upper income people taxed more than lower income people because they own more property. However, home values, that's the property that middle and lower income people are most likely to own. Home values do not rise in value as much as income does. Lower income folks own homes that are valued at a particular amount, and as incomes go up, yes, home values that people own go up, but they don't go up as much as income does. So home values are greater relative to incomes for lower income than for upper income homeowners, and that introduces a regressive element into the property tax. And then finally, taxes on rental housing are passed through to tenants on higher rents. And this is one of the most difficult things about tax incidence studies in general. What about taxes on businesses, like taxes on rental housing or commercial apartments? When you tax a business, the business will adjust. This is a distortion, right? The businesses will adjust their operations in such a way that some of the taxes may be passed forward to customers in higher prices or passed backwards to employees in lower wages and benefits. Only a fraction of the taxes actually accrue to the owners of the business. And with rental housing, we can see that quite easily, because ask anybody, do landlords raise the rent when their property taxes go up? And I think almost all of us believe that yes, they do. Now, economists also believe that landlords will lower your rent if their property taxes go down, and regular folks don't tend to believe that. I think we lack the time for me to explain why that is. But at any rate, certainly you can see higher property taxes, and that's what counts here. Higher property taxes make for higher rents. And what that means is that tenants are effectively paying some of the property taxes that are levied on rental housing. And since renters, or let's put it a different way, since low-income people are more likely to be renters than higher-income people, the fact that renters indirectly pay their landlord's property taxes is another regressive element in the property tax distribution. So Indiana ranks 39th among states in reliance on property taxes, and so we miss that progressive element. It fails to provide a property tax circuit breaker credit for low-income taxpayers, says ITEP. And we say, wait a minute, we've got something called a circuit breaker. Well, what we call a circuit breaker is not what everybody else in the country calls a circuit breaker. Circuit breakers elsewhere in the country mean that you are limiting the property taxes based on a percentage of income. Here, our circuit breaker, what we call a circuit breaker, is actually a tax cap. It limits our property taxes based on the value of property. So if you are limiting the property tax as a share of income, it means that if you have a low income, even if you own a home, that might reduce your property tax. So we don't have that, and ITEP likes that because it could reduce property taxes for low-income folks. They also say, though, that allowing a generous homestead exemption is what sets less regressive property tax systems apart from the most regressive. And we do have a generous homestead exemption. It's the fixed $45,000 standard deduction, and then the 35% supplemental deduction on top of that. And that really does reduce homeowner property taxes. And the fact that the fixed $45,000 is a bigger share of a lower valued home than it is of a higher valued home means that it introduces a bit of progressivity. It means that the property tax doesn't actually tax a very large percentage of low valued homes and does tax a very large percentage of upper income homes. Well, for that reason, that's probably why we have this weird profile for our property tax. The lowest 20%, they pay more. Why? The lowest 20% of income earners pay more. Why? Because they're renters and they're paying their landlords property taxes through their rents. But you go to the second in the middle, the second 20% is quite low relative to the middle, and that's probably the $45,000 standard deduction, which for lower homeowners, and the second 20% are the low-valued homeowners, really does reduce their property taxes as a proportion of their home values, as a proportion of their incomes, more so than upper income folks. And then you look at the very top and you see that the top 1% and top 4% have higher property taxes than the next 15. Well, that's the ownership of businesses. Right? The upper income folks own the businesses, they pay the taxes on the businesses. That is the progressive end of the property tax. So a really mixed bag as far as the property tax is concerned for ITEP, the folks who favor systems that promote equality and equity. What about the individual income tax as well? That's the proportional or even progressive element, potentially, in a state and local tax system. Now, we've got a flat tax. Now, a flat rate percentage tax on full income would be proportional. Everybody would pay a certain percentage. Right? You can create progressivity in a couple of ways, though. You can create progressivity, that is, have higher income people pay more than lower income people, if you have a graduated rate system. If the tax rates on upper income people are higher than lower income people. Federal income tax is that way, at least as far as its rate structure is concerned. Or you could do flat rates with high personal deductions. If you have high deductions, that will be a bigger share of low-income people's incomes. If your personal deductions are high enough, you can eliminate income taxes on low-income people altogether. Personal deductions may be a very small share of a really high-income person's income. And so the flat rate would apply to most of their income. So a flat rate with a high personal deductions can also create a progressive structure for your income tax. Can be made more progressive with refundable credits like the earned income credit, the earned income tax credit for lower income people. Refundable credit means you get a tax break even if you're not paying income taxes, even if you don't pay any of the tax. They'll give you a tax return. Tax features of Indiana. Indiana ranks 22nd among the states in reliance on individual income taxes. We've got the local income taxes, and so that's a positive from ITEP's point of view. We're relying on the tax that can be progressive, but we use a flat rate, and we have comparatively low income tax exemptions. So in the end, ITEP doesn't like Indiana's tax that much. We do provide a refundable earned income tax credit on top of the federal earned income tax credit, though, and they do like that. Here's what our profile looks like, and this is exactly what you'd expect out of a flat rate tax. You look at the middle through the 20 through the top 1%, and it's all in the mid 3 to high 3% range. Well, that's where our state tax plus our local tax will put you after deductions are subtracted. The lowest and second, as you can see, it moves up from lowest to second, and that's the effect of both the earned income credit for the lowest 20 and what personal deductions we actually have for the lowest 20 and the second 20%. So it's got a progressive profile, but not as progressive as ITEP would like it to be. Here it all is combined. Income in green, property in yellow, sales in red. You can see the declining profile, the regressive sales tax. You can see the combined progressive regressive property tax. you can see the mildly progressive income tax. When we put it all together, Indiana's system looks like this. It's regressive altogether. The progressivity of the income tax does not offset the regressivity of the sales tax. So if you look at this profile, ITEP goes and puts it into an index and then ranks the overall index. Indiana is the 12th worst, or conversely, 39th best of the taxes. So that adds up to 51. DC is not included in this, but if you think about it, if you were first best, you'd be 50th worst. Those two numbers add up to 51, so that's just the way the arithmetic goes. ITEP doesn't like us much. Tax Foundation likes us a lot. ITEP doesn't like us very much. Why don't they like us? It's our flat rate income tax with low personal exemptions. The progressive tax, or tax that could be progressive, isn't as progressive as it could be in Indiana, and we have a greater reliance on the regressive sales tax. So the worst of the taxes from their point of view is the one we use the most, and that knocks us down in the tax inequality index. So the inequality index is 12th worst. If you flipped it to make it an equality index, it would be 39th best. So we're low on that ranking. All right, let's put these two together, and this, I think, is very, very interesting. Imagine, well, first of all, let's take a look. The Tax Foundation and ITEP clearly disagree about what makes a good tax system, and I've got a couple of points here. Tax Foundation, this is a quote from them, they don't like progressive multi-rate income taxes. They say it is inefficient because it reduces both the quality and the quantity in the labor pool. It creates this complexity. It increases the distortions. They don't like progressive income taxes. ITEP really likes progressive income taxes, relatively progressive, largely because of the graduated marginal income tax rates. They like progressive. So these two organizations directly disagree on the value on the of progressive income tax rates. They disagree on the sales tax too. The Tax Foundation would prefer a broad base, which means they would say, hey, don't exempt groceries, right? That benefits grocers. It benefits high-income residents. It introduces a distortion, makes people buy more food and less of everything else. It increases compliance costs. They say, don't exempt groceries. Of course, ITEP says, are you kidding? Food is what low-income people buy with their incomes. Don't tax it. It's particularly regressive if you do tax groceries. Tax Foundation and ITEP disagree about sales taxes on groceries. All right. Here's what I've done. Let's do a scatter diagram. Let's do the two rankings. The ITEP ranking of tax equality. Let's rank them based on equality so that one is best and 50th is worst. And let's put them on the vertical axis. And then let's put the business tax climate, Tax Foundation's business tax climate, on the horizontal index. Their top-rated tax there to the state to the left, their least favorite climate, business climate, to the right. And you might think there's a trade-off. Of course, there is a trade-off between these two. These two organizations disagree, and you might think that states would show up on the red line. That is, those that ITEP ranks low would be ranked high by Tax Foundation. If you've got a really good business tax climate, you must have low tax equality. Likewise, if you've got really high tax equality, you must have low tax climate. So upper left, if Tax Foundation likes you and ITEP doesn't. Bottom right, if Tax Foundation doesn't like you and ITEP does. Let's take a couple of states as an example. South Dakota. South Dakota has got the third best business tax climate, and they're 47th on tax equality. Tax Foundation loves them, ITEP hates them. On the other end of the scale, California. ITEP thinks they're the best tax system in the country. Tax Foundation's got them 49th. So you can see here it is, the disagreement. Where is Indiana on this scale? We're towards the South Dakota and away from California. We are 10th on the Tax Foundation Business Tax Climate Index, and we are 39th on ITEP's tax equality rank. So the value judgments Indiana has made. What's important in a tax system? Being friendly to business we regard as important. Tax equality, as measured by ITEP, we have regarded as less important. That's where we are on the scale. Where else? Now, you might think, okay, all the states, they're going to line up, all the dots are going to line up on that red line. When we rank them all, they're going to be up and down on that rank line. Sure, they'll vary a little bit from the line. But if you were ranked high by ITEP, you'll be ranked low by Tax Foundation. If you're ranked high by Tax Foundation, you'll be ranked low by ITEP. Right? Wrong. Common sense loses again. These dots are all over the scale, all over the map. What does that mean? That means that there are 4 states that the Tax Foundation likes because they've got a great business climate, and ITEP likes because they promote equality. Some states satisfy both states. Some states are the best of both possible worlds. And then there's those 4 states there. And then there are other states. There are 9 states that both organizations think are terrible. It's states that have terrible business tax climates and, oh, by the way, promote inequality and are hard on their low-income people. So the fact that Indiana's on the line means that we are at least good in one aspect. It's possible to be terrible on both. Well, where are our neighbors? Where are our neighbors ranked? Well, here they are. There's Michigan. Excuse me. Michigan, pretty good from the Tax Foundation's point of view, towards the middle from ITEP. Right, they're not quite on the line. They're sort of inside the line. Being inside the line, in a sense, is better than being on the line because you haven't sacrificed equality to get your business tax climate, or you haven't sacrificed as much business tax climate to get equality. So there's Michigan. But clearly Michigan has made the judgment that tax equality is a little more important than Indiana does, and they've sacrificed some business climate in order to get there. Kentucky's even further down this list. Right? They've got a sort of middling tax equality rank and a middling business tax climate rank. And Wisconsin, even further. Tax Foundation really not very high on Wisconsin. They're ranking them about 33rd, but ITEP has got them near the top third, and ITEP has got them ranked 17th. So Wisconsin has, again, made the value judgment. The people and government of Wisconsin made the value judgment that business tax climate, less important, tax equality, more important. Well, what about our other 2 neighbors? What about Ohio and Illinois? And I am gleeful, forgive me, Ohio and Illinois, gleeful to report that Ohio and Illinois are among those 9 states that score terribly on both lists. Ohio, 42nd on the tax climate list, but did they sacrifice business tax climate in order to improve equality? No, they're 38th on the tax equality list. But look at Illinois. Illinois ranks lower than Indiana on both lists. How do you achieve that? What do you do? I'm not going to go over what's bad about Illinois' system, but whatever it is, boy, the Tax Foundation hates it, and so does ITEP. They are bad on both business tax climate and tax equality. You know, in our competition with Illinois, we can say to the businesses of Illinois, hey, we've got a much better tax climate than Illinois does. We can say to all the taxpayers of Illinois as well, all the households, hey, tax equality is promoted more in Indiana than it is in Illinois. Not much more, but we're better as far as tax equality is too. How about that? Turns out there are 7 states that are worse than Indiana on both lists, but 2 of them are immediately to our east and immediately to our west. But also, that implies that we can do this. Right? There's our rankings, 10th for Tax Foundation, 39th for ITEP. There are 5 states that are better than we are on both lists. 5 states that have better business tax climates and are easier on low-income people than Indiana is, according to these 2 groups that value these 2 things. Now, who are these states? Well, what is New Hampshire? Well, Tax Foundation loves New Hampshire because they don't have a sales tax and they barely have an individual income tax, and so you get 10s for all of the income and sales tax categories as far as the Tax Foundation is concerned. Even though that means it's a narrow base with high rates on the property tax, Tax Foundation still likes them. Well, this is not really comparable to Indiana. We're not going to get rid of our income and our sales taxes, so we can't really take much in lessons from New Hampshire, and ITEP doesn't think they're all that hot as far as treating low-income people well either. That's Alaska right there. Alaska, again, not very comparable to Indiana because they've got all that severance tax. They've got all that tax of the oil extraction, and that keeps their other taxes low. So not really comparable to Indiana. Here we've got Utah. Here we've got Oregon. And that leaves us with one state, the champion state, the state that is in the top 10 of both lists. And both of these organizations make a big deal of who's in the top 10, right? There is one state well, Oregon is one, but within the top 10. There's one state in the top 10, right? Ranked 8th by ITEP on tax equality, and ranked 5th by Tax Foundation in the business tax climate. Who is this paragon? Who is this state that can be all things to all people? Who is it? Montana. Surprise, surprise. What has Montana got that everybody else doesn't? Well, I'll tell you what it is. Montana does not have a sales tax. Tax Foundation loves it when you don't have a tax. ITEP loves it when you don't have the sales tax. Oregon is the same. They don't have the sales tax. Right? And so here's Montana and Oregon. Can Indiana learn anything from that? Not really. We've been moving towards the sales tax over the years, and so we're not going to eliminate it. That can't be done. Which is why I want to pay a little bit of attention to Utah. Utah is the other state besides Indiana that's in the top 10 of the Tax Foundation's Business Tax Climate Index and uses all the major taxes. Utah has, of course, property taxes, and a corporate income tax, and an individual income tax, and a sales tax. Everybody else in the top 10 besides Indiana, Utah, eliminates one or more of the major taxes. So Utah is the state we need to compare to Indiana. Now, Utah's business tax climate is like Indiana. They're a little better than us. They rank 8th. But they're much better than we are as far as ITEP's tax equality rank. Right? They rank 12th on tax equality, and we're 39th. What is Utah doing to achieve these rankings? Well, here's Indiana's profile, and here's Utah's profile. The first thing you see is that the levels of taxation are lower. Well, one thing Utah does is raise more revenue from non-tax sources, and the Tax Foundation or ITEP are just looking at taxes. So there is that. But the thing to look at here, when you look at Utah, you see the sales tax is regressive. Well, there's nothing you can do about that. Sales tax is going to be regressive. And you can see the property tax is also up and down, just like Indiana's. It's the income tax that makes the difference. Right? Here's the income tax for Indiana, and you can see mildly regressive up to the mid-3 or the high 3s. Here's the income tax for Utah, radically regressive, or excuse me, progressive, radically progressive, from the lowest all the way up to a higher rate on the top 20% and especially on the top 1%. So why, how did they do this and still maintain their business climate ranking? Because the Tax Foundation hates these graduated tax structures. Well, Utah has a flat rate tax. They've got a flat rate tax at 4.95%, which is a lot higher than our 3.23, until you add our local taxes in which case, on average, we're in the upper 4s. And so we've got a tax rate very much like Utah's. But what we've got are low individual personal deductions. And what Utah has is high deductions, exemptions, and credits for low-income people. If you've got an income less than $20,000 in Utah, you don't pay income taxes. If you're under $35,000, you pay very little. It's only once you move beyond that that those deductions and credits run out and you start to pay at that flat rate income tax. That's how they do it. They've got big deductions and exemptions in their state income tax with a flat rate. Tax Foundation likes the flat rate. ITEP likes the big deductions for low-income people. And here is the other thing that ITEP likes. You take a look at their reliance on general sales. Utah, 25%, Indiana, 28%. You look at their reliance on income, Indiana, 26, Utah, 30. So Utah is less reliant on the most regressive tax, more reliant on the most progressive tax, and their version of that progressive income tax is more progressive than Indiana's version of the progressive income tax. That's how Utah does it. That's how they end up towards the top of both lists. All right, and here it is. Here's the overall profile. Dark blue for Indiana, regressive the whole way. Light blue for Utah. As you can see, progressive in the lower 80%, mildly progressive in the lower 80%, which means that their income tax progressivity offsets their sales tax regressivity for the lower 80%, only at the upper level. Does the flat rate tax on the income tax set in, and we get the regressivity. All right. That's more than enough. Takeaways. Indiana taxes. Indiana has the 34th highest, 18th lowest, counting D.C. State and local tax percent of income in the U.S. Our property and our excise taxes are particularly low. Our individual income taxes are in the bottom third. Our general sales and corporate income taxes rank in the top half, although our corporate income taxes are declining. Indiana has one of the most balanced tax systems in the U.S., third most balanced, second most among states, taking D.C. out of there. Near equal shares of sales, income, and property taxes is what makes that happen. That allows a broad base with low rates, which Tax Foundation particularly likes, and it gives at least the potential of a balanced portfolio that may help with stability in recessions. Takeaways again, Indiana has the 10th best business climate in the U.S. according to the Tax Foundation's index. Low rates, broad bases, flat rate individual and corporate income taxes, and declining corporate income tax rates. That's what the Tax Foundation likes in our tax system. But Indiana has the 39th best tax system promoting income equality. That's 12th worst, according to the Institute on Taxation and Economic Policy's index, the ITEP index. That's a flat rate income tax. They don't like that, with low personal exemptions and greater reliance on the regressive sales tax. And that's how we compare among the states in the United States, plus a few comments and lessons, I guess, about what kinds of criteria you economists tend to use when we look at taxes. There you have it, a look at state and local taxes in Indiana. Tamara, turn it over to you.
Okay, we'll take a 5-minute break during that time. If you want to submit questions into the chat box, we'll be back in 5 minutes to answer those. Okay, we're coming back for questions, and before I get started on questions, I did want to share just some updates on things that we have going on. Don't forget to follow us on Twitter at INTaxRockstars if you are a Twitter user.
Yeah, inclined to just do so. What do we got, about 970 followers now, I think, somewhere in that neighborhood?
That's something you keep track
of.
of.
Yeah. Well, somebody's about to become our 1,000th follower.
Oh, that is exciting.
That is, yes.
We have scheduled all of our local government finance workshops, the regional workshops that we do for the next 2 semesters. The next one's coming up on November 20th in Tipton County. And I will send out that flyer with all of those dates when I send out this recording.
That will be with the updated 2019 data for the first time, right? So
yeah, well, we've already done Cass County.
Yeah, we always did one with 2019. Okay, so up-to-date data.
And then finally, we're working on how you may have a complete counts committee in your city or town or county.
For the census.
For the census coming up in 2020. And so we're looking at ways that we can help local governments educate their constituents on the importance of the census and census data. We love census data and are excited about getting some updated demographics here soon. And so we're looking into a webinar on that, but if you do have a complete counts committee and you are doing some cool things to promote or educate on the census, feel free to reach out to us. We would love to hear about that. Okay, let's get to some questions. Okay, comparing median income in Utah with Indiana in the lowest quintile. Would increasing income in the lowest quintile reduce the percentage of tax paid by the lowest quintile?
Well, that takes a little mental gymnastics, actually. That's interesting. And let's try to do some concrete. Suppose you increase the minimum wage, for example, and you know, suppose most people with jobs kept their jobs when you increase the minimum wage, just so that we can have an example here we can work with. And so suppose that raises the incomes of the low 20th percent. So what happens? Well, for one thing, the quintiles change. Now the division between the lowest 20 and the next up 20 increases, right? The income division. So so that moves and in a sense doesn't change very much. Since we've got a flat rate tax with deductions, if your low income goes up, you pay at the full additional marginal rate, which is 3.23% in Indiana for the state, and then whatever the local is. But you don't get any more deductions because you've still got the same number of people in your household. So the taxes, as income goes up in the lowest quintile, the taxes go up as a percentage of their income, I think. That's how that would work. So with that, and I think ITEP would look at that and say, yep, that's one of the problems with the flat rate tax. Because marginally speaking, as your income goes up, you pay, the low income person at the minimum wage pays at the same additional rate, pays the same additional percentage tax as the millionaire does when their income goes up. So one of the votes against flat rate taxes from ITEP would be for that reason.
This one's from Clay County. What is considered the average middle class income, and what is considered a family on fixed income?
Oh, that's a good question, and I didn't look at those numbers. I'm struggling to remember because I have looked at those census numbers recently, at least for the median. The median family and median household incomes are different, so it depends on what you want to look at. Households include people who are not considered families, that is, single individuals. Families include only groups of two or more, however families are defined. So the family income is greater than the median income. I'm wanting to say that the family income's in the 60s and the household is in the 50s, but that's something I really ought to look up. So can we set that aside and give me a reminder to look that up?
Sure.
And we'll see what that is.
We can send that out with the recording.
Yes, let's do that.
So this is from Jackson County. What is your take on different county assessors treating affordable housing property tax exemptions differently?
Yeah. Well, I'm going to be an economist and say on the one hand, on the other hand. Here, on the one hand, we've got a state oversight agency, the Department of Local Government Finance, that has made progress over the last 20 years in getting local assessors and local county governments, auditors, treasurers, assessors, to standardize the treatment of property across all counties. And that tends to be good tax practice so that, you know, here's a distortion that is eliminated, right? You can't move to a particular county and get a better tax break than you can in another county other than the differences in the tax rates. So, you know, it eliminates a distortion. On the other hand, what is affordable housing in Hamilton County and Crawford County could very well be very different numbers, you know, because it depends on what are the typical incomes in these places. And so affordable housing, when you're in a low-income area, has to be a lower-priced home, and affordable housing, what's in a higher-income area, has to be a higher-priced home. And so one could easily imagine assessors, auditors looking at this and saying, well, I know we're supposed to be standard, but come on, these counties are very, very different. And so that's my take on it, actually. And in a sense, it is a conflict between the Tax Foundation point of view that you don't want to introduce new distortions, and the ITEP point of view that, hey, you've got to allow for differences in incomes.
I'm actually reading this next question and thinking that it's really a great question.
Okay.
Do you have any information on the low-income public services load for the state of Utah versus Indiana?
Yeah.
Do they have the expenses at the bottom end like Indiana does?
Oh, my goodness. Isn't that right? These two organizations look at taxes only and not on what we do with those taxes, right? What we do with the taxes matters. And there's a good deal of research out there that looks at, what's the impact of taxes, different tax levels, different tax features on business location. But there's also research that looks at public services on business location, right? And there are certain public services that businesses really like. They like roads. They like the transportation network generally. They like a quality labor force, which might come out of your public education system. They want their property to have police protection. They want fire protection. And these are all things that local and state governments provide. And so you might say, hey, we've got high taxes, but we're providing businesses with greater services. And wouldn't those two things offset? And there is research out there that does say that they offset, but that's not research that the Tax Foundation focuses on. They tend to look just at the impact of taxes on business location. So I don't know. Utah, always exceptional as far as its standings in the social measures, right? And certainly the religious aspects out there have that impact. So I don't really know, but it is an excellent question. And it is another one, I suppose, although that one would be harder to do. But no, not so much, not so much. Okay, here's what we can do, okay? Tamara, this is another to-do list for Larry, okay? The Census of Government's information that they put together has state and local taxation, but also state and local expenditures. So for 2016, we should be able to find their expenditures on education, but also on welfare, on other services offered to low-income people. So we should be able to look relative to Indiana, what are the levels of these services delivered?
That sounds like fun.
Well, it does actually, because I've already got the information on a spreadsheet. It means just looking at a different row and saying, okay, let's see where we rank on those things. That would be, I don't know, maybe for next year, a whole nother on local government. How do our expenditures compare across the state? So thank you for that question. That is a very good question.
Here's a question from Tippecanoe County. Do any states implement a progressive sales tax on luxury items?
Well, of course, that would not be a general sales tax. I believe there are excise taxes on some luxury items. I remember didn't the federal government a few years back in the early 90s have a yacht tax or something like that? It was rescinded pretty quick. But,
I've never bought a yacht.
Yeah, well, I know. Well, exactly, right? But boy, isn't that a good example of the difficulties of tax incidence, right? If you put a tax on a yacht, what happens? People buy fewer yachts. And so the people who build yachts don't get paid. Well, who are the people who build yachts? I don't know, carpenters, middle-income people, some even lower-income people hired to, cart things from here to there. You've got fewer sailors, I suppose, as well. And so these people lose their incomes. In a sense, some of the taxes that we put on the owners of the yachts actually accrue to the employees who may be middle and low-income folks. So tax incidence can get really, really complicated. And again, it's another thing I'm not up on, and I really don't know where we might find that particular information. But if there are such things, they would be excise taxes, and they would be a very small parts of the total tax take, and I suspect they would not make that much difference in the profile. Their sales taxes and their excise taxes. The sales tax profile, sure, it depends a little bit on whether you tax food or not, on what's included in the tax base, but it's that savings thing that the upper income folks save and the lower income folks can't. That makes all the difference for the sales tax. And I don't care what you tax with the sales tax, you're not going to beat that as long as you're raising the significant amount of revenue from the sales tax. I mean, if all you had was a yacht tax, sure, that would basically hit upper income people probably more than lower income people, though, of course, you've got the incidence problem, but you wouldn't raise any revenue. Indiana, in particular, would not raise much revenue from that.
You could probably take a yacht on Lake Michigan.
Yeah, well, that's true. You know, there are big boats. We had a boat. We have a big boat builder down on the Ohio River, right?
Sure.
Are they still down there?
I don't know.
Okay.
Okay, so in our October on local government, generally we like to take a higher look at things, more of that 30,000
yeah,
foot
30,000 foot, yeah, paint
view.
with a broad brush.
But we do have a couple of questions about what does this mean for local government in Indiana.
Okay. Just generally, what does it mean for local governments in Indiana? Well, in general, okay, to the extent that you've got choices. Now, one of the things that this means is that Indiana, as we've seen, is more like a southern state than a northern or midwestern or northeastern state, and southern states are top-down states rather than bottom-up states, which means that we live in a state where the state government tells local governments what they can and cannot do to a greater degree than you would find in New England or in the rest of the Midwest. So what does this mean for local governments? It means you do as you're told, basically, by the state. So it means that. To the extent that you've got options, right, local tax options, you can look at your own business climate, right? And you know, what does the Tax Foundation like? You get this publication from the Tax Foundation, and they will have that list of 118 elements that businesses are concerned about. Some of those elements you might have some influence on, and so you could get that and take a look. To what degree have you got any influence at all on equity is the question. Well, you know what? Local income taxes are more equitable than property taxes. So if you move to, you know, ITEP would probably say on the local level, if you move towards income taxes, paying for your local governments with income taxes, and less towards property, even though property is this mixed bag, right? That would probably be progressive. Even giving an income tax break to landlords, which then get passed on in lower rents. Now, I know nobody believes that. But believe me, there are good reasons to think that that actually can happen. That might be progressive. Tax breaks that accrue to lower income folks on the property tax might be another, if you can find a way to get that done. So our local income tax hits upper income people a little bit more than lower income people because of the deductions, or at least is proportional. And so if you can apply more income taxes and make less property taxes, that might nudge your system away towards greater equality, but there's not that much room in order to get that done. Because remember, raising your local income tax, you're not giving your low-income folks any more deductions. And so the marginal tax that they pay has gone up. Well, yes, it's a flat rate tax. You may be eliminating some of their property tax, and so they might come out ahead. But you do have to analyze that. You have to be more careful about that. It's possible that you can make that happen. Okay, so I'm thinking as I'm talking here, and I've gone and done these sorts of calculations. If you levy a property tax and give the full reduction to residential property, either homeowners or homeowners plus rental housing, you will reduce the property taxes of low-income homeowners more than the tax increase they will receive in income taxes. So that would be something that local governments could do if they're concerned about equity. And again, if you're concerned about business climate, get the Tax Foundation's publication, look at the list, see if there's anything on that list that you can do.
Well, I think to the other side of things, right, we also have expenditures or the services that are provided. Yeah. And so we do have a comment here about with the difficulty of altering the mix of taxes and their corresponding rates, it would appear that Indiana state and local units might need to focus more time or attention on reducing administrative costs of governmental units, which would be another way to reduce taxes.
Yeah, it would. That's right. Streamlining local government procedures could edge tax rates downward. Now, I know when you and I looked at the issue of consolidating townships, we found that the impact on property tax rates very, very small. But there, if you remember the Kernan Shepard report from how long? About 15 years ago now. There were a number of ideas there to consolidate government functions in a way that might save costs. But as we found out with the township thing, sometimes those can increase costs too. I think about fire protection in Indiana a lot when I think about this. You think about the different ways that fire protection are provided in Indiana. There must be a dozen different ways, professional versus volunteer, township versus city, special districts, and, providing, having cities provide it to rural areas, having rural fire departments provide it to other rural areas. An enormous number. You might think this is a crazy quilt thing. Why don't we just consolidate it countywide or something like that? Well, you know what? It's efficient to deliver different levels of services to people who have different fire protection needs. And the way we achieve that in Indiana is allowing a dozen different ways of providing fire protection. And so, rationalizing, consolidating, could save, but you got to be careful.
Here's another question. Could you please clarify what a local state sales tax would be defined as? We have some confusion here as to what in Indiana would qualify as a local sales tax that isn't or is a tax in other states.
Okay, what it is a county being able to say, hey, the state collects a 7% general sales tax. In this county, it's 8%. And that 1% that's collected by all the businesses and all the sales in our county, that goes to our local government. Now, what have we got? We've got some restaurant taxes of 1% tacked on, and so in a sense, that is a limited additional local sales tax. It doesn't raise enough revenue to add up to 5% of the total sales, so it doesn't show up in Indiana on the way I did the data. But the census doesn't count that as a general sales. They would count that more as an excise tax because it's a tax on a particular product and not a general tax across a wide range of products. If you're on the Illinois border and you cross over into Illinois, you can experience local sales taxes firsthand. And these are just, basically it's the equivalent of our local income taxes. In Indiana, if the county so decides, we can tack on an income tax rate on top of our state income tax rate. State collects it, remits it back to the local governments. In states with local sales taxes, you tack a sales tax on to the state sales tax. State collects it, remits it back to the counties. That's how it works. That's what's different from what we do in Indiana.
We have a question about how can we find information about specific counties to compare to others in the state. I just want to say that's exactly what we do in our regional local government finance workshops. So I think that Gateway has a lot of information on there if you want to kind of comb through the data yourself.
CCRD's website as well, right?
Yeah, it's getting a little old, but we also have the Rural Stats Indiana website that has some county-specific data, especially from our capacity cost index research that we did a little while ago. They also have housing data and some other data on there that's helpful too. And then we, of course, put out our county reports to anywhere that we do the regional workshop for the year. And so that's Washington County. You should have a report, I think, from last year. I think we were down there. If not, take a look. I think we're covering Washington when we go to Jackson County in January.
So there's various places you can go. You can go to the DLGF website and get the tax rates for all of the local governments and all of the taxing districts. You can go to the budget agencies, the state budget agencies website, and they have the local income tax rates and revenues.
And the LSA property tax reports are also very useful.
They I believe has stopped doing those now. They didn't do one. And no, Tamara's looking at me in shock here. They didn't. I believe they did not do one for 2018. What's happened is the property tax from 1998 through about 2012, 2015 was the tax issue, and legislators needed to know. And it's kind of faded now. We've essentially got the system that we're going to have now, and so LSA has decided to put their resources into other studies. So I think we're going to miss that.
It is 1 o'clock, so we are going to cut things off because I know many of you need to get back to other things today. But we do have several questions left. We'll go over these and send out some answers with the recording as best we can.
As best we can.
Thank you so much for joining us today, and be looking forward to that email with the recording as well as information about upcoming programs and the questions and answers that were left.
Right. And I'm really glad that this has created so many questions. In a sense, it means we didn't cover everything we should have covered, but on the other hand, it means that it's inspired folks to start thinking about some issues that maybe they wouldn't have thought of otherwise. So, especially, like, what are they doing in Utah? I know I hadn't thought about that until the weekend when I put this together.
Okay, so thank you and have a good day.
So long.